Hello and welcome back to The Note. Let's talk today about the great flavour of the month in fund management, so-called smart beta funds. Very systematic, transparent strategies which aim over time to beat the market. Are they really so smart? Are they really so new? Is there a danger if they really catch on that they will end up eating up themselves, doing away with the advantages they're trying to exploit? With me now to discuss this is one of the forerunners or pioneers perhaps of the concept. He's the founding partner of AQR, Cliff Asness. Cliff.
Thanks, John.
Thanks for joining me once more. Cliff, you've probably in the camp of people who've done academic finance who rather dislike the term smart beta. Is it actually anything new?
Well, I got to be clear. I have disliked the term. I'm bowing to it. Right. Language is a democratic process. Enough people use a term. Eventually you have to acquiesce or no one knows what you're talking about.
Exactly.
I do not think that most of the things we're calling smart beta, and it's an umbrella term. Maybe there's some things I would change my tune on, but most of the things we call smart beta are tilts away from a cap-weighted index. Traditional indices, the S&P 500, others, are weighted by capitalization. And quantitative finance, academic finance, practitioner work has shown over time there are some strategies that many of us believe can beat cap-weighted. The most famous of them is a so-called value strategy, owning cheaper things. Things like momentum, things like low beta, low volatility, quality. These are things that to various degrees academics and quantitative practitioners on Wall Street have been looking at for at the least 20 years, many longer than that. Fisher Black wrote about low volatility strategies in 1970, roughly 1970. My problem with smart beta as a term, I'm in the weird schizophrenic position of liking the strategies and not liking the term, it was really relabeling things that have been around forever. In that sense, it's been a really good marketing relabel. It's probably benefiting me too, but it's not so new. You asked if it's new. The other is more of a quibble. This one's more minor, but I think of beta as something that we can all invest in without making it go away.
In the original Greek formula, it's the return on the market.
It's the return on the market. So smart beta to me is literally, you can literally write it down, the math, as the return on the market, the true beta to me, and the deviation from the market, the bet. I think of it as an active bet. It's a simple active bet in the direction of some time-tested strategies I believe in. That's the part where I love the strategies. But it is neither beta in my view. It's beta plus an active bet, just like all active portfolios. And I don't think it's particularly new. So I'm betwixt and between.
Okay, but you obviously have fairly great respect for the fact that this term has been used to bring the strategies that were previously regarded as more esoteric to
yes, I lost that fight. The term is a good one.
Now, does that mean now that everybody gets smart beta, everybody gets that you should be betting on cheap stocks eventually to revert to the mean, on momentum to continue, does that mean that those anomalies are going to become overcrowded, that they're finally going to close? You yourself are betting on those anomalies in many of your funds. Is that something that worries you?
Got to answer carefully. The universe of things that worries me is certainly broader than the universe of things I expect to happen in the near term. So to say I'm not worried would just be false. I worry about these things. I don't think it is as obvious as many do that if something is known, it goes away. Something can work on average. I use the word work meaning a little more often than it doesn't. Doesn't mean it always works. But a strategy can add value on average because it takes a risk, and that risk is rewarded. It can add value on average because there are behavioral biases, so-called behavioral finance reasons, behavioral psychology, and some investors make an error that you try to exploit. Either one of these, people can know about, but as long as some people want to take the other side of the risk or continue to make the error, can still deliver returns. Now, I have to recognize, and anyone doing anything that's not cap-weighted has to recognize the truth behind your question. If enough people do it, there is some level that will shrink and ultimately destroy the excess return to something.
But is there any statistically valid evidence that the weight of money we've had so far has taken us any distance towards that level? Are those effects working less well than they used to in any statistically meaningful way?
Working less well is different than measuring how they're going to work going forward.
Yeah.
What we particularly like to look at, and this works best for the value strategy. Other ones are also measurable, some are more difficult. Momentum, for instance, is a hard one to get a handle on measuring its future efficacy. But the value strategy, you can look at whatever you consider cheap stocks and expensive stocks and go, how big is the difference? If this ever goes away, in the industry we'd say was arbitraged away by too much capital, we would expect that the ratio of those valuations, the difference between them, to collapse to unprecedented levels. That would be the mechanism where we'd observe this occurring. The only thing we've ever seen truly abnormal, we saw the opposite once. Back, this is ancient history now, but 15 years ago in the technology bubble, we saw the opposite, where expensive got super expensive to cheap. Value did horribly, but was poised to do much better than ever. Right now on these same ratios, not a perfect predictor year in, year out, but we think it would catch this over the long term if it ever truly happened. They look pretty close to normal. So I can't deny smart beta has grown, but we have a very deep market. Smart beta is still not a tremendously large portion of it, and wherever it's taking the capital from, we don't know what they were doing. If they were active stock pickers who had a value tilt on to begin with, and a lot of money left active stock pickers to move to an explicit value smart beta product, doesn't necessarily mean that it's changed the dynamics. So I do worry about this. A running joke at my firm is, I'm not sure if I should worry about it or wish for it, because if it hasn't happened yet, it's going to be a convoluted sentence, but I'm going to try to pull it off. If it hasn't happened yet, the process over hopefully a long-term period, 10 years, 15 years, of this anomaly going away is normally a very profitable one for its investors. People buy what you're long or overweight and sell what you're short or underweight. If you have a 40-year, 50-year, 100-year horizon, you probably don't want this to happen. You'd rather the anomaly exist forever. If you're getting to be about 50 and can see doing this for maybe 15 years, as some random people in your video might be, 10 or 15 years, maybe you'd sign for that. But the world doesn't do what I want it to do anyway. Bottom line is we don't see a lot of evidence that it's gone away yet, but anyone who doesn't admit the possibility of what you said thinks there's magic in the world. Because if there's something is a deviation from the market, that deviation can go away.
Okay. Cliff, thank you very much indeed. It's always a pleasure. I think, to sum up, following Keynes in the long run, we're all dead. In the short term, smart beta looks as though it stays alive. It's much more of a marketing concept than any truly new academic concept, but it's obviously a very powerful marketing package of an idea that is still working.